The average student loan in the UK is now estimated to be £45,000. Some of those loans have an interest rate currently at 7.3%. And under the current system, only around 25% of students can expect to pay back their loan in full. So it begs the question, should you be looking to overpay your student loan? The key difference and what makes this so tricky to answer is that at some point that loan will get wiped. With a normal loan, it's much simpler to calculate. You're simply just looking at the interest rate you're being charged and then looking at what you get on your money elsewhere. So for example, if you're getting, say, 5% on your savings and the loan's only accruing at 4%, you might make the decision that it's actually better to save more of your money than pay off that loan. But the fact that at some point that student loan will get wiped, if you're not guaranteed to pay back that loan in full, if you make overpayments, you're just paying more money unnecessarily. There's loads of calculators out there which can help you work out how much you're going to pay back, whether you're actually going to pay back the loan in full, and whether it's worthwhile actually overpaying the loan. I'll leave the link to the one that I've been using in the description. A lot of this will depend on which repayment plan you're on. There's currently 5 different plans. You'll be on plan 1 if you started uni between 1998 and 2011. You'll be on plan 2 if you started uni between 2012 and 2022. Plan 3 is for postgraduates. Plan 4 is if you went to Scotland, and plan 5 is the most recent plan, and that's if you started uni in 2023. We'll come back to the most recent one, plan 5, because that's where some of the most sweeping changes have occurred. For now, we're just going to focus on plan 1 and 2. If you're on plan 1, you have arguably the best deal out of all of these plans. The interest rate is currently 4.3%, and that's based on either RPI or the Bank of England base rate plus 1%, whichever is lowest. The current Bank of England base rate is 4.5%, which means it would be 5.5, and RPI is currently 4.3, which is why it sticks at that figure. The RPI figure is an inflation figure that's taken 6 months before the September for that term time start. The period after which the loan gets wiped is also the lowest at 25 years. So after 25 years, you haven't paid back the loan in full, it will get wiped. Let's compare that to plan 2. So for plan 2, the interest rate goes up to 7.3%. It's based on RPI plus 3%. So while you're at uni and studying, you'll get an interest rate of 7.3%. And then after you graduate, there's a sliding scale from 4.3 all the way up to 7.3, depending on how much you earn. So the more you earn, the higher interest rate you'll get. There's also a slightly longer period after which it gets wiped. So this is 30 years compared to the 25 years in plan 1. Another slight difference between these two plans is the amount at which you need to earn to pay back the loan. So both of these plans, you will pay 9% of the loan of the amount that you earn over a set threshold. So for plan 1, that threshold is £24,990, and plan 2 is £27,295. So that means if you have 2 people that earn exactly the same amount on each different plan, the person on plan 2 will actually pay less of their loan back because the threshold is higher at which they start to pay back their loan. Another key difference between these two plans is the tuition fees. These two plans coincide with the increase in tuition fees. So the people in plan 2 will actually have tuition fees that are almost 3 times as much as some of the students that were in plan 1. So not only is there higher potential interest rates in plan 2, it's also more likely that the students in plan 2 are going to have a higher total loan amount. So here comes the deciding factor. You need to use that calculator to actually determine if you're going to pay back that loan in full. If you're in plan 1, it's more likely you're going to be able to pay back that loan in full. You've got a lower interest rate, and you're also likely going to have a lower total amount. We'll come on to potential options if you do decide that you want to overpay. If you're on plan 2, again, you need to decide whether you're actually going to pay back that loan in full. It's only based on an estimate because obviously you don't know how much you're going to earn in the future. But if you put your stats into the calculator and it comes out that you're actually not going to pay back the loan in full within that 30 years, then there is no point in you overpaying. You can essentially just see your student loan as a graduate tax. You've got an extra 9% marginal tax rate on your earnings until that loan is either paid off or it gets wiped at 30 years. Now, plan 5, this is where some of the most sweeping changes have come in. So this was more designed around trying to get more people to pay back their loans in full. Like I said at the start, it's estimated only around 25% of people will actually pay back these loans in full. With plan 5, there's 2 big changes. The first is that the time at which it gets wiped goes to 40 years. So compare that to 25 in plan 1 and 30 in plan 2. That's a massive change. The threshold at which you also start paying back the loan is £25,000, which is pretty much in line with plan 1, but it's actually slightly lower than plan 2, which means if you earn the same amount compared to plan 2, you'll actually be paying back more of the loan. And when we take into account that you don't get the loan wiped until 40 years, that 25% which can be expected to pay back the loan in full goes up to 70%, which can be expected to pay back those loans in full. So out of all the plans, plan 5 is definitely the one where it's worthwhile looking into whether you can overpay, because you're so much more likely to have to pay back that loan in full. So what are your potential options? Now, don't take this as financial advice, this is just my take. So first off, if you calculate that you're not going to pay back the loan in full, you can essentially just see this as a graduate tax of 9%. And one way that you can actually reduce how much you're going to pay is through pension contributions. So when you pay into a pension, this comes out of your gross salary. So this actually reduces the amount of taxable income that you then get charged on, which is where the tax relief comes in. And your student loan is exactly the same as tax and national insurance. It comes out at the same time. So if you can reduce your taxable income by increasing your pension contributions, then you actually pay less back of your student loan. So if you fall into that camp and you're deciding whether to do more savings and investments or pay more into your pension, paying more into your pension can have a much bigger weighting than it would do ordinarily. So what if you've calculated that you will pay it back in full? Then of course you want to reduce the amount of interest that you're going to pay over the period. For the people in plan 2, it's going to be so much more worthwhile overpaying because you have the slightly higher interest rate of 7.3%. That can change, but it's based on RPI plus 3%. So it's likely always going to be more than you would get on a savings account. So even if you can only afford to overpay by say £50 or £100 per month, that can make a massive difference in the long run. If you're on plan 1 or plan 5 and your current interest rate is 4.3%, well then it's a bit more of a balanced approach. It's still worthwhile paying more of that back because you will reduce the interest that you'll pay. I think it's more of a balance because you want to make sure that you've got some emergency funds parked away. So have a bit more of a balance in terms of how much you're saving for now, how much you're investing into the stock market for the long run. Still, pension contributions can be a big impactor as well. And then have that balanced approach between if you've got money left over that you can afford to pay extra, then again, that £50 or £100 per month doesn't need to be much, but it can work in the long run. If you're on plan 1 and 5 and the interest rate is currently 4.3%, you could almost look at this similar way between that decision of should you overpay your mortgage or put more into investments and savings. And it's a similar sort of decision because the interest rates and returns are going to be very similar. In the long run, in the stock market, you can expect returns on average around 10%, but there's volatility that comes with it. That's obviously not guaranteed. That's just what it's done previously. But if you base it on that longer term approach, then actually it's more worthwhile putting money into the stock market that is going to be paying back a loan that's currently at 4.3%. The interest rates on the loans are based on inflation, which has been coming down and is expected to continue to come down. But if for whatever reason it starts to go up again, then that means you're going to pay more interest on the loan, which then moves the needle closer and more advantageous towards actually paying more of the loan back. In terms of what you'll get in a savings account, again, that's going to be very much based on the Bank of England base rate, which again has been coming down. The base rate was put up to counter high inflation, which has been coming down, and then the base rate has been following that. So as long as inflation continues to come down, then you can expect the base rate also to come down, which then also means that you're going to get less return on your savings. So in summary, a lot of this will depend on which plan you're on, how much of the total loan you've still got left to pay, whether you're actually going to pay back in full at all, and how much you're potentially going to earn in the future. Take a look at the calculator, which I'll put a link to down below. This will help you to calculate how much of the loan you've still got left to pay. It'll tell you what your interest rate is. It'll tell you how many years until it gets wiped, and that will help you to determine whether it's worthwhile overpaying your student loan. I hope you found that useful. Thanks for watching. Subscribe if you're new, and I will catch you in the next one.